Thank you for joining us for our webinar today as we provide a COVID-19 update. Today's topic is Money Talks, the options available for businesses now. My name is Lee Schwartz. First of all, I just want to hope and state and ask, hopefully, that you're all healthy and staying safe. As you may have seen in our initial invitation, we were originally going to have a representative from the Wisconsin District of the Small Business Administration join us. Unfortunately, yesterday we were informed that they have been told not to participate in any webinars or events until further notice. My hunch is that even they still have some unanswered questions. So now seems like a good time to mention that everyone at SVA, and our presenters in particular, are working feverishly to understand all the options out there. Today's presentation will cover everything we know at this point in time. Please keep in mind this information is fluid and can change quickly. I also want to make it very clear, if you have questions coming out of this webinar today and you're an SVA client, please reach out to your SVA professional. We want to help. If you're not an SVA client, your best bet may be to go to your existing CPA. They know you best. But if that doesn't work, please feel free to reach out to me directly. We understand this is an incredibly difficult time for all of you. And if there's some guidance, advice, or even just a second opinion that'll help you in this process, we're happy to do it. The more we all help each other at this time, the stronger we'll all be on the other side of this thing. Our presenters will begin with clarifications and FAQs on the SBA loan options, and then we'll cover some medium and longer term planning. We are going to leave plenty of time for Q&A, so please hang with us. In order to ask a question, just open up the chat function within Zoom and address your question to all panelists. Please make sure you don't submit questions until after we've covered a topic. I'd like to make sure we don't have questions asking about specific items that we end up covering. Now, with recording this webinar today, you will receive an email with a link to a survey, as well as our SVA resource page where the webinar recording will be available. Our presenters today are Eric Trost, Dan Glomsky, and Nancy Melberg, all principals from SVA. Having said that, I'd like to kick it off to Nancy.
Thank you, Lee, and good afternoon, everyone. I'm glad that you've joined us for this second webinar as we talk about some SBA loan options. So the first thing I want to start with is some clarification. So for many of you who sat in last week on our presentation, we went over the differences between the EIDL, Economic Injury Disaster Loan, and the PPP loan, the Paycheck Protection Program loan, which is part of the CARES Act. So as we discussed this, there were some items that were still open for interpretation that we still needed clarification on, which we now have some answers on. So I'd like to start and go over that information before we get into some of our frequently asked questions. So the first clarification is in regard to the EIDL. So originally we said that there was a $10,000 forgivable advance on the loan. When you applied for the loan, you would put in your bank routing information and that advance would be sent to you within 3 days. We have recently learned from the SBA that that is a maximum advance of $10,000, and that advance is actually $1,000 per employee. So if you have 3 employees, they're going to advance you $3,000, which will be forgiven, by the way, but it is not an automatic $10,000. And that was some clarification that we just received from the SBA. Another thing that I want to clarify is there was a lot of conversation and a lot of concern around applying for both the EIDL and the PPP. We have recently learned that you can apply for both. As many of you might have seen if you've already applied for the Paycheck Protection Program loan, that there is a question on the application asking if you have applied for the EDL and if you have received any funds. If you did, you were to put those funds down and those would reduce the amount of the loan you would have received for the PPP. However, many people did not get those advances prior to 4/3, and I'm sure there's still a lot of you that are still in the process of filling out that EIDL loan, in which case you do not have to deduct the proceeds from the PPP as long as you certify that those proceeds will not be used for the same thing. So if you recall from the last webinar, if you sat in on it, the EIDL loan could be used for working capital, and the PPP can only be used for payroll costs, rent, mortgage interest, and utilities. So if you're using the EDIL for working capital, inventory, paying your vendors, then you should be fine. Also, we've recently learned that the terms of the PPP have changed a little bit. Originally, we were told it would be up to 4% interest for up to 10 years. However, we're now learning that the interest rate is 1% and it's a 2-year amortization. However, the SBA has informed us that banks can determine if an amortization period longer than 2 years is necessary, depending on the hardship your business has suffered. So it sounds like there is still some ability to drag that amortization period out to 10 years, but standard terms of this loan are 1% for 2 years. And also the EIDL can be used for real estate. And I believe on the actual application, there's a spot where you can put in lost rent. So these were some of the things that we just wanted to clarify. And now I think what we're going to do is Eric and I are going to go through and we're going to talk about some of the frequently asked questions we've received in the past couple of weeks, or the past week really. And then we'll open it up for some questions you might have at the end. So I'm going to let Eric start this off.
Thank you, Nancy. So this is going to feel a little bit like you're watching one of those Hollywood award shows. Nancy and I are going to alternate with questions here, give you different voice inflections. First one, as an owner, can my wage be included in the calculation of the borrowing base for the PPP loan? Simple answer is yes. Up to 100,000 of your compensation can be included when you're calculating the PPP loan proceeds. So what does that mean? Let's say you own a business and you're the only employee, okay? You can still get this PPP loan to protect your own payroll. Nancy, would you like to go next?
I am here. Sorry, had my microphone muted. So I think the next question is, how are the total payroll costs calculated? We've gotten this question a lot, and we've actually heard some conflicting information on this, and some of it we're going to clarify in some of the other questions. But the simple answer is total payroll costs are calculated by using your gross wage, state and local employer portion of the taxes, which is really just state unemployment because here we don't have any local taxes, health benefits, and employer retirement plan expense. So a couple things that I want to point to when we talk about this is when we're looking at gross wage in the calculation, and then we also look at health benefits, what we have to do is we have to make sure that we are not including any of the premiums that the employee is paying that's being deducted out of their paychecks. So if the employer is paying the whole health insurance bill, but the employee is having a portion deducted, we need to make sure that we're deducting that employee piece of the health benefits into this calculation. That's the total calculation. You take it for the entire year divided by 12. That's going to give you the average times 2.5. And we're going to talk a little bit more on some of the clarification about these total payroll costs as we go through these.
All right, next question. Let's say you operate your business as a partnership, and typically this would be an LLC. So you'd be operating as an LLC, and instead of a wage as an owner, you're getting what's called a guaranteed payment. So a guaranteed payment, different than a wage. A wage has tax withholdings out of it. It's reported to you on a W-2. But if you're operating as a LLC and you're getting a guaranteed payment, there are no tax withholdings and there is no W-2. And that guaranteed payment doesn't show up on any payroll tax forms. It only shows up on a K-1 reported to you at the end of the year. And so the question is, can you use that guaranteed payment as part of your total payroll costs to calculate the PPP loan? We believe the answer is yes. I don't think there's clear guidance on this right now. And we have used the K1 and as a supporting document with the guaranteed payment on it in calculating the PPP and submitting it to banks. And several banks have accepted it, although some banks have come back and questioned it and said, should this really apply? We believe the intent of the law is that this does apply, and we'll continue using guaranteed payments in our calculation of the PPP loan until we're told specifically that we can't do it.
So the next question, if we were playing a game, this would probably be the $1 million question, because I think this is a question we've received quite often and have had a lot of different answers on this. So the question is the $100,000 cap only on compensation, or is it calculated on an individual basis, including all of the payroll tax or payroll costs, which again, the payroll costs is going to include employer taxes, health benefits, and retirement plan? Our answer to this is the calculation is capped at $100,000 in compensation only, not total payroll costs. We have seen some banks request different information for this. However, we just recently got some guidance from the Treasury Department that clarifies our position here, that the $100,000 cap is a cap on compensation only and not total payroll costs.
Thanks, Nancy. You said that was the $1 million question. Isn't that really the $100,000 question? Next question.
You're right.
Should payroll taxes be deducted from the gross wage in determining the total payroll costs? So when we made this slide, we were of the position that no, the employee portion of payroll taxes should not be deducted in determining payroll costs. And then the AICPA issued guidance and said that payroll taxes should not be deducted from the gross wage in calculating payroll costs. So, we took a position that we believed was the intent of the law. The AICPA reinforced that position. And then just last night, some guidance was issued from Treasury that did confirm that position, so that when you're looking at your payroll costs, what you're really looking at is the gross wage that you're paying an employee, not the net wage. And so let me explain the difference there. Let's just take an employee who gets a gross wage of $4,000, and then from that wage has $500 withheld. So for those of us who get a paycheck, we've all seen that there's our gross wage, and then, the disappointing taxes come out, and then we're left with what is left over. In calculating the PPP, you get to use the gross wage that appears at $4,000 and not the net wage. And that's important because there was actually other guidance issued that now is out of date and old and obsolete that said you had to use the net wages. And so if somebody is behind on their guidance and they read that and it says use the net wages, they're using an incorrect piece of guidance. And so if you are talking to your bank and they are referring to net wages after payroll taxes are taken out, I do believe they're using the wrong guidance, and they should be corrected with this new guidance that it is in fact the gross wage that you use.
Thanks, Eric. So I think as many of you can see is between this point and the point I made a few minutes ago about not capping total payroll costs at $100,000, but only capping compensation at $100,000. And now we're not reducing it by payroll taxes. I'm hoping that many of you are saying that this is actually going to increase your loan, hopefully significantly for some people. So you want to make sure that if you haven't filled out the application yet, or even if you have, but your bank has not submitted it yet, that you're taking a look at this, because this could be some significant, a significant increase in the borrowing base, and you want to make sure that you're utilizing as much as you can. So the other question here, can independent contractor payments be included in wages and compensation if you do not have employees? The answer to this question is no. Really, this has been pretty clear cut. I think early on, we were hearing that they could be, but the guidance since the original bill came out has always been no. And the reality is that independent contractors can apply for their own PPP loan using their 1099 income as their self-employment income. So this actually opens up on Friday. So last Friday it opened up to businesses. This Friday it's opening up to independent contractors. So we encourage everyone, if you are an independent contractor, to get your loan application ready to submit this Friday.
So I'm going to take two questions now. I'm going to take one that was sent in to our panelists here and the one on your screen. I'll take the question sent in from a listener first. Sound a little bit like a radio show calling here. Andy writes in, what if your LLC compensates owners via distributions rather than guaranteed payments? Can distributions be included in the PPP? So it's a bit complicated. I'd say the answer is yes, okay? But let me explain that. So again, we're going back to an LLC and the owner is getting not a wage, as typically LLC owners either get distributions or guaranteed payments. I addressed guaranteed payments before. Andy's asking, well, what if it's just a distribution, not a guaranteed payment? And what we've done on applications where this has occurred is we actually use your income that's allocated to you on line 1 of your K1. So on your K1, if you were getting guaranteed payments, that would be reported there and can be used as support for the PPP, and that's what we've been doing. But we've also have an application in that was accepted that used the ordinary income allocation from line 1 of your K1, which really is your distributable income. Next question I'm going to go to is back to your screen then. Can I use 2019 payroll data, or does it have to be trailing 12 months? Little typo there. Can I use 2019 payroll data, or does it have to be trailing 12 months? The answer is you can do either. So in guidance that was clarified last night, Treasury specifically said you can use your 2019 year, or you can use your most recent 12 months. The 2019 year is typically what we've been using. If for no other reason, it is very tie-outable. It typically, for calendar year reporting, all your 941s, which are your quarterly payroll tax reports, your Form 940, your W-2, and your W-3, those are all prepared on the calendar year basis, whether your company is a calendar year reporting company or a fiscal year reporting company. So we've typically been using the 2019 calendar year to tie out and calculate the PPP. Although the other option is available, you can use the most previous 12 months. So you could use, say, for example, April 1st of 2019 to March 31st of 2020 as your most recent year for calculating the PPP.
Thanks, Eric. So the next question is something that I think people are having some concerns about. And if the question is, if my lender is no longer accepting applications for the PPP, what options do I have? This does get a little bit tricky because this particular loan does not go directly through the SBA. This particular loan you do need to go through your lender on. Most banks, from what I'm seeing, are taking priority applications. In other words, they're taking their own clients first. Then they're opening it up to maybe clients who have depository accounts there, and then finally the general public. I am hearing that there are lenders out there right now that have already stopped accepting applications. Now, I did talk to someone from the SBA yesterday, and they indicated that there is no cap that a bank has on the amount of SBA loans that they can accept. However, we don't know guidance that individual banks have on possibly their lending. So is it possible that a bank has a legal lending limit and they're including these SBA loans in there? That's possible. We don't know the guidance on what the banks are doing, but I would suggest that if your bank has no longer stopped taking applications, reach out to another bank, possibly a community bank that might be close to you. Even if it means you have to open an account there, I would suggest doing that. Otherwise, you can also go to the SBA's website, www.sba.gov, and they have a list of lenders based on zip code in your area. So I think there's still some time. I know that there was some panic early on about getting these loans in. SBA is accepting loans until June 30th or until the funds run out. However, you know, we can't tell when the funds will run out, but we are telling people to continue the process and fill out your application if you haven't done so.
Yeah, thanks, Nancy. And to add to that, I do believe it was Senator Marco Rubio who expected the funds to not run out until about June. So I don't know if that's optimistic of him. But I have also seen that there is potential that there would be legislation to add another $200 billion to this fund. So that's potential legislation. We don't know that that is going to happen or not. But I think what happens if this $350 billion that's currently allocated to this runs out very quickly, and we are still in this crisis, I do believe there's going to be another shot of capital that'll be injected into this loan program. I'm going to take a stab at two more questions again because we've got another listener question. This comes from Dave in our audience. How are temporary workers handled, and are bonuses included in payroll costs? Dave, that is two questions, but we'll take a shot at answering both. Bonuses are included in payroll costs, so it can be a flat salary plus the bonus, as long as total compensation for an employee, their gross wage does not exceed $100,000. Anything over $100,000 is just not part of the calculation. And then how are temporary workers handled? Our guidance right now says that you do include your temporary workers if you are using a PEO, a professional. Nancy, what would PEO stand for? Professional Employer Organization?
Yes.
Okay.
Yes.
So if you are using a PEO, you can use the wages of that PEO. Now, how do you know what those wages are? I think you've got to get some kind of evidence from the PEO on what the actual wages are for those folks. So that is good news for those that are using temporary workers. It should be included in your PPP loan calculation. It's just a matter of figuring out how to get that information to include.
And I would like to add to that I have seen some emails and some letters that PEOs are actually providing to their clients. And the letter essentially says that we are not filling out an application for a PPP, for the PPP loan using your employees for the loan basis, and encouraging the employers to use their own employees for that loan basis. So I think it wouldn't hurt if you use a PEO to get some type of a letter or an email from your PEO and submit that with the payroll information to the bank.
And next question is, what information do I need to submit with my loan application? And I would say at a minimum, banks are all asking for 941s, which is the quarterly payroll tax reports where you reconcile your payroll tax deposits with the amounts that were withheld from your employees. At a minimum, that plus the 940, which is the year-end report for unemployment that reports all your wages. And then each bank seems to have other forms that they are asking for, whether it be payroll reports or occasionally they ask for a tax return as well. It should be noted that the banks are not required to replicate your calculation. So if you give them information and have a calculation on there, it's not like the bank checks every number and ties out your calculation. Some may be doing that, but they are certainly not required to do that. They're simply required to take a reasonable effort to oversee that you have given the proper documentation for the loan.
Thanks, Eric. So for the loan forgiveness portion, now I know we're getting a little bit ahead of ourselves because this loan forgiveness application will not happen until after this 8-week covered period. But I think we should note this because I think this is important to people as you get these loans and you enter into this time frame where you're going to be really using your payroll costs for forgiveness. So it's going to include the payroll costs that we talked about earlier. So again, gross wages, health insurance, retirement plan, and state unemployment. Then you can also use rent, utilities, and mortgage interest into your calculation because those are the only items that loan proceeds can be used for. So they're going to come into play for the loan forgiveness. However, the payroll costs need to account for at least 75% of those costs. So these other costs, rent, utilities, and mortgage interest cannot exceed 25% of the forgiveness amount. And this was a very simple calculation, and the calculation came from the fact that they are comparing an 8-week covered period for payroll to a 2.5-month payroll costs, which is what the loan basis was for. So you would never, your 8-week payroll costs would probably not equal the 12 weeks, or I'm sorry, the 10 weeks that you applied for the loan on. That's where they got this 75-25% split on this loan forgiveness piece.
Yeah, thanks, Nancy. And I think this is going to be important come the end of the loan when you are applying for your loan forgiveness. Here's where I'd suggest you're talking to your accountant along the way, and certainly at the end before you apply for the loan forgiveness to make sure you have that documentation in order and the calculation right, so that you get the proper amount of forgiveness. We have a couple more questions yet from the audience. So Nancy, do you see them on the
Yeah, so let me address this one. I guess one of the questions is, are the payroll costs covered based on earned payroll or paid payroll? Everything that I'm seeing in our interpretation is it's based on paid payroll. I think, a lot of you probably know that for payroll purposes, it's deemed when the checks are written. So I don't understand why it would be any different for these purposes. So it's going to be based on when checks are paid. So I want to just talk about something really quick as I mention this, because if you bring your employees back, let's say you applied for the loan and you expect proceeds, I'm going to use 4/15 as an easy date. And you bring your employees back if you would have laid any of them off by 4/15 to be covered in this 8-week period. You have to understand that if you're a biweekly payroll, they might not get paid for 2 weeks. So you're already going to be into that 2-week period. So I think assuming that we can pick the 8-week covered period that we want to use between 2/15 and 6/30, it would make sense that you would want to pick your 8-week period starting with your first payroll once you have everyone back on at 100%.
So Todd from our audience asks, if I am a sole member of an LLC and I file as an S Corp and have a salary of 60,000, and the rest of my compensation is via distribution on the K-1, can I add the distribution to the 60,000 salary? The answer for that is no. So what you have is a situation where you have a owner of a company that's an LLC that elected to be taxed as an S corporation, and therefore that owner, who is also an employee of that S corporation, actually gets a wage, a W-2 wage of $60,000. Then they take out other money from the company in the form of a distribution from that S corporation. The only thing that can be used in calculating the PPP is the $60,000 wage.
So thank you, Eric. I think we have a lot more questions coming in, and so we still have a little bit more information that we want to cover here in our webinar. So I think what I'm going to do at this point is I'm going to turn it over to Dan, and he's going to talk about a few things, and then with whatever time we have left, we will try to get back to some of these questions. Thank you.
Thanks, Nancy. Thanks, Eric. You guys did a great job with passing on some of that information. And I'll go through my piece, you know, as quick as possible. But I thought it was important that we look, you know, try to help clients to look a little bit further forward and make sure that we're taking care of what we take care of right now immediately. And that's great, but not to lose sight of what really you know, some of the other things coming up on the horizon that we might need to be prepared for, and how do we maneuver through that. So for that perspective, these are really uncertain times, and I kind of view this as, you know, time to take some flying lessons. And you know, not that I've ever been a pilot or anything like that, but, you know, in an airplane, we have a big instrument panel. There's tons of levers to move, and, you know, those full throttle forward, pull it back, you know, adjust flaps, you know, that type of thing. So I thought it was a very good analogy as far as how to kind of maybe look at your business and how things are going currently. Yeah, so we start with the instrument panel, and, you know, I start here because I think this is an important point to mention is, you know, we have to know our business, and we have to know what indicators are out there for our business, and what how they affect things, and what they predict. The other thing I want to note, everybody to note, is that the plane you were flying for the last couple of years may not be the plane you're flying currently. So, and into the future. So some of the instruments or some of the indicators you may have looked at in the past may not be something that you might want to focus on right now. Not saying that they're not still part of your instrument panel. It's not like you took them and threw them out of the airplane, but it's something that you may want to decide to look a different route from that perspective. But what I wanted to talk about next is the you know, the business statuses. And some businesses right now are going, you know, current operations, no changes, and that's great for them. The caution I have on that is we're definitely experiencing some economic effects here. Depending upon how long this thing, you know, the virus continues to impact the economy globally and locally, we have to understand that our current business that is operating just fine today is likely going to experience some kind of economic stale or pullback, maybe in the short-term future, maybe a long-term future. The important piece here is to really understand, you know, what could end up being reduced in your business, and what markers are going to be good indicators that you are experiencing an economic trend that might be long-term playing, and be prepared for that, be able to react and move quickly if that were to happen. And some of the things we'll talk about in the future or next couple of slides are really to prepare you as you maybe experience some of those. We also have businesses that are operating at less than capacity. So maybe some things are just going fine. You know, there's a segment of our business that you know, continues with no disruption. And then there's our parts that we have no revenue coming in and have some disruption. So again, you have that balance of, okay, I got to monitor what's going well. If something's going to change, I want to be prepared for that. if things have dropped off, you also want to make sure you shut down the expenses that are feeding that. But I caution a lot of people in this is to still stay relevant, right? Just because you shut your doors or you're not getting more revenues, maybe it doesn't mean you stop your connection with your clients. Maybe it doesn't mean you, stop doing business, stop doing planning and that type of thing. It's, you got to really stay engaged in the process, but manage your costs. Know what costs you can control, what costs you should shut down, and what costs may be necessary to continue. Then we have businesses that are shut down. And the important part here is we have no revenue coming in and we have expenses going out, deciding which revenue or which expenses we need to shut down and which revenues or which expenses we need to continue and how do we continue those. Other piece of this is setting a measurement to decide that helps us indicate when that business is ready to come back live. Now, it could be the government allows you to, open back up and the stay home order is relieved, and that is an indicator. But what does that mean for your business, and how long is it going to take that cycle to start producing some revenue? And how do you participate earlier in that process than later? Again, these are things that I really want businesses to start to think about so that we are ready and anticipating these types of opportunities. And cash flow is a big part of that, especially in one that's shut down where I have no cash flow coming in, but I have to be able to fund some expenses, one in the startup or the ramping up of business or the continuation to stay relevant. I referenced the word cash is king, and cash is king is really an old term, but the point I really want to drive home here is by being liquid and having some cash availability really gives you, some flexibility to implement the strategies that you want to employ and where you think you need to take your business. So a lot of these things that we'll talk about from a cash flow planning perspective are things that I think will allow you the flexibility to do what you need to do. It'll allow you to move faster. And it also is a good indicator of, how your business is doing and what potential you have to do certain things. A lot of businesses have done cash flow planning, and a lot of times, we do business projections and they're done annually. And then each month we take a look at how our budget is compared to our income statement. I'm going to challenge everybody to evaluate that, not only from an income statement perspective, but now a balance sheet perspective as well. And the following slides, I'll talk about balance sheet items. And the reason I'm doing that is because when we do a cash flow plan and we start looking at the assets on the balance sheet or the liabilities on the balance sheet, it tells us kind of how things are moving with respect to that income flow and how we prepare for a ramp up in business, but also if certain things start falling off, let's say revenue or accounts receivable start taking a little longer in collection, what do we need to adjust in order to get that cash flow still to stabilize and yet allow us the flexibility to do what we want to do? So if you're not doing a balance sheet cash flow planning projection, that's something I would strongly encourage you to do. And the frequency is another thing we want to consider is, at what frequency is it? Is it a weekly projection? Is it a monthly projection? I certainly wouldn't go any longer than a monthly. The ability of a cash flow plan, it's a planning opportunity, but it also is really for understanding the influences, both internal and external, on your business. Part of the cash flow planning we start with is accounts receivable. And as accounts receivable, it starts with the invoice process. You want to make sure that your invoicing is done timely and accurate. You don't want to give a customer an opportunity to challenge the invoice and defer payment as a result of an inaccurate invoice or one of not being issued timely. So, that's where it all starts. I ask you to monitor payments, make sure that, we all have the terms that our clients expect, and that's okay. but you want to make sure that you're monitoring them, and you want to make sure that if they're dropping off or things are changing, that you start opening that dialogue with that customer and make sure that you understand what's going on, because that's going to allow you to make the correct adjustments in your cash flow model to be able to subsidize or bridge that temporary cash inavailability. Next, we have inventory, and I say manage appropriately. And when I say that is we go from order to use to collection. So that's really our, our cash flow cycle. And when we look at inventory, we all the time preach that you don't want to have excess inventory. You don't want to have old inventory. And, this is a classic example where if somebody has a lot of inventory that hasn't been used or hasn't been turning in time, you're sitting on a lot of cash flow. And, now is the time to use up that old inventory, repurpose inventory, limit the shrinkage beyond what maybe you've already been trying to do. Plan, determine how much time it takes, for you to get your inventory into the door and out the door and starting to produce cash flow for you. Understand your suppliers, their limitations, and their support. Potentially, sell back inventory to suppliers. I'm not suggesting liquidating your inventory or anything along those lines, but it's more so understanding your options. I'm not trying to encourage anybody to panic here. What I'm really trying to hammer home is understand your options, understand what you can do with the assets you have, and try to preserve that cash flow activity, both currently and as we get through 2020. As part of our balance sheet, we also have investments, and investments, we'll see it where clients have a life insurance policy that has a cash surrender value. There might be an ability to take a loan against that. Again, not suggesting anybody run out and go get that cash surrender value of the policy or take out a loan against it. I want you to understand what options you have with respect to that. Same thing if you hold marketable securities. The market's been recovering pretty nicely for the last couple of days here, but there's also days it's swings dramatically the other way. Here's where you include your other advisors, right? Your wealth advisors. And if you're going to build that use of that security into your cash flow model, make sure your advisor's aware of that and make sure that their plan is the same as yours. Fixed assets, hold off on purchases. It might be that based on the market conditions, the piece of equipment that you were looking to buy for years has substantially depreciated in value, and now is the right buying opportunity. So evaluate that, but make sure your cash flow plan can handle that absorption of cash flow, and you still can achieve what you need to do given the uncertainty in the sales side. You might switch from to a scheduled preventative maintenance on equipment versus we're just going to ride this thing until it breaks down and then we'll replace it. And then, balancing production. If you have limited, if your capacity's dropped off and you have a couple machines that produce the same thing, maybe you alternate machine use. That gives you some ability to maybe get one to last longer than the other. Again, caution here is you want to make sure you understand the long-term play of doing such a thing. You don't want both the pieces of equipment wearing out at the same time where you have double the capital expenditure costs at that one time. So again, it's really understanding what you have as options and making sure that you're leveraging them. From a liability perspective, we have accounts payable. And my colleagues have encouraged me to suggest that a lot of the things I'm about to talk about here doesn't refer to the CPA, the accounting bill, but we ask that get paid first, in all humor set aside. But we want you to understand your vendor payment terms and leverage as much as you can from that payment cycle. And if you can, communicate with your vendors at this point, extension of terms, maybe potentially get another 30 days of extended payment terms. The reality of it is the payment terms may not be relevant to you today, but what they are relevant to is when you start to flip the cycle going the other way, and you start to have an increase in purchases now that don't translate into sales for another 30, 60 days or 90 days. And that translates into cash even later. So the longer you have to pay that for that inventory on the front side, the longer you have to do some flexibility until you get it into the revenue side and then ultimately cash flow. A planning opportunity from that perspective. From the debt perspective, I want everybody to take and understand what they have as far as their existing bank debt and have a discussion with their banker. The bankers at this point understand the economic uncertainty, and all the banks that we've talked to with clients have been very accommodating with respect to terms. But we need to look at the line of credit and maybe see the opportunity to increase that limit. Again, it's not on maybe the immediate cash flow needs today, but it could be, what does that cash flow model tell me that I need as far as cash flow once my revenue starts picking back up? We have to look at the loan ratio adjustments. Some loan covenants require a particular net worth of the business or a percentage of inventory or percentage of accounts receivable. Well, currently you might be depleting all those because this revenue is not coming in, inventory we're not purchasing. So that ratio starts limiting our ability to take out a line of credit on the upside as we start wanting to bring in more inventory, might extend the terms to an accounts receivable. We want to make sure that our bank is ready for that and that we have agreement so that when we get to that point, we don't run into the challenges and we don't exhaust time trying to get those adjustments. Other possible options are, switch to an interest-only loan at the time, right? See if you can say, oh, can I just pay my interest and defer my principal? Can I defer principal and interest? These are just options or levers to pull. I'm not suggesting that you have to defer your principal payment. Your cash flow model might tell you you're fine on that, so you don't need to worry about that, and you want to, from a business perspective, continue to pay down debt. But those are the things that I think businesses should be thinking about and being prepared for. And finally, the government assistance, and Nancy and Eric have done a great job of going through the PPP. There's also the EIDL loan, which are the two programs that the government has really made available for businesses during this time period. There's also the tax credits that they've offered and the extension of the individual tax return due date to July 15th. These are all opportunities for businesses to get to a period of maybe a little more certainty. So I encourage taxpayers that haven't filed their return and have a balance due, although you might have the cash flow available today to pay that, why not wait until July 15th until we got a little more certainty as far as where things are going and how much cash flow we need in order to get there. Again, do the cash flow planning, understand where you're at, and that will be kind of also a driver in this. The key to the tax planning or the tax credits and deferrals is really understanding what help is available to you. There's going to be more help coming at some point in time, so continue to stay up to date on those types of things, and SBA continues to monitor all those things as well. So in conclusion, I really have three takeaways from this segment, just trying to give everybody a little more perspective to think about as they go back to the drawing board. One is set the correct markers to monitor your business and monitor them frequently. Again, I can't stress enough, the time horizon of looking at stuff annually or every 6 months is I don't think that's going to be a new normal. I think we have to start looking at a shorter time frame and start looking at everything 3 months or shorter in some cases. Two, look beyond the runway and set the plan, right? It's the horizon's out ahead of us. We have to aim for it, and that's where we're going. We have to plan accordingly. And then stay engaged. Do not panic. These are things that, the more you understand your business and you understand what you can adjust. That's what's going to help you stay calm and maneuver through this process. So that's all I have for my part, and I think I can turn it over now to for questions.
Thanks, Dan.
Yeah.
That was great information.
Yeah.
So looks like we got about 10 minutes left here, so I'm going to dive into a couple of questions. So the first question I have here from Rob is, if we have an application submitted to the SBA, is there any guidance as to how we know this is accepted? Is there a confirmation number? When will they release the funds? So we have seen some applications already accepted by the SBA, and what they do is they assign you a loan number. So you will get an email in the mail or in your email with a loan number. And I believe those applications are submitted to the bank fairly quickly, and then the bank will release those funds to you. I believe the funds are released in one lump sum. And I think this whole process from the time that you get your loan number till the time the funds are submitted happens fairly quickly. So does anybody else want to grab another question?
And Nancy, Ryan asks on the calculation of the PPP to pretend my payroll calculation for PPP is $100,000. The SBA application asks to multiply the payroll by 2.5. That is the total forgivable portion, correct? 250,000. So really what he's asking first is, calculating your PPP loan is your average monthly payroll times 2.5. And your average monthly payroll can be calculated by looking at your yearly payroll. So let's say 2019 in this case, the total year payroll, getting all those payroll costs, getting out the payroll that's for those that are making more than 100,000, and dividing it by 12, and then multiplying that number by 2.5. So in Ryan's case, it would be 250,000. That's your loan amount. That loan amount is also your forgivable amount, but your forgivable amount now is calculated on the back end after you look at the next 8 weeks of payroll cost spending, of utilities, of rent, and of interest. So you calculate your forgivable amount after you look at the 8 weeks of spending that you're using the PPP loan for.
So Eric, you bring up a really good point. And so I think the issue here that people have to understand is these are two separate calculations. And so we have the calculation for the loan amount, which is what Eric went through. And then there will be another calculation that will happen after the 8-week period when you've paid your employees. And then there is some possible reduction in that loan forgiveness, because let's assume that in this 8-week period, you only brought people back at 75% capacity. So your total payroll costs are going to be lower in general because they're not at the full capacity. And then there's also a calculation to determine were they, was the capacity reduced more than 25%, and did your total FTEs go down? So there's a couple more calculations. So I guess the moral of the story is the fun isn't over yet. We have a little bit more calculations to do in the weeks ahead. But I think once you get that loan, I did read another question somebody asked, should I set that money aside and use that to cover payroll? And my answer would be absolutely. So if you do get $250,000, I would set that aside, use only that $250,000 to cover your payroll in that 8-week period. And then you can decide as a business owner, whatever is not forgiven, to take the rest of the money and pay it back, or keep it at a very low interest rate of 1%. So we have a little bit more fun ahead of us.
And I think it's also important to note that, the ask for as much as you can get. If your payroll costs end up being less and you want to just repay the loan, when repay that portion that's not going to be forgiven, that's an option. But if you ask for too little, you're not going to be able to go back and ask for a bigger forgiveness later.
That's a great point, Dan. And remember, even if you only get 75% of it forgiven, it's still 75% of, I guess, free money, we'll call it.
Another question comes from Christine, who said, any updates from insurance companies for those of us that have interrupted business coverage as to whether the insurance company will pay out for COVID-19 business loss? And so far, she's saying they have denied us. I haven't heard anything on that yet. Have either of you two?
Yeah, one of my attorney clients, I talked that topic through. A lot of policies you have to have experienced some loss of some physical loss and like property damage of some nature or disruption in business beyond just and some have a virus exclusion and so forth. So their suggestion to me was that was going to be a tough process for a lot of policyholders. With that being said, you still have the claim opportunity. You should submit the claim, make it known. There is also some state legislative activity out there that might prevent some insurance companies from continuing to deny such type of impact. So I would, kind of keep that in their back pocket. But at this point, I would agree. It seems like it's going to be a difficult proposition.
I have a question here. Somebody is asking if they can use the proceeds of this loan to reduce their line of credit, or do funds need to be accounted for in a separate bank account? I don't think they need to be accounted for in a separate bank account, but you have to use the funds to cover only those costs that we talked about earlier, which was payroll costs, rent, utilities, and mortgage interest. I don't know that they're going to be tracing funds. I don't know how they could do that, but there is a line on the application that you are using the funds specifically for those purposes.
So Nancy, I think I saw a question out there where somebody was asking whether the independent contractor application was available. I don't think I've seen that yet. Is that correct?
I have not seen it yet. I'm not sure it's going to change, to be honest with you. It might still show average monthly payroll. I'm guessing that they're going to be referring to the average monthly self-employment income, which my guess is would be calculated the same way we've calculated average payroll. So the net self-employment income divided by 12 times 2.5. The only thing I'm not sure about at this point is the forgiveness piece of that. If we anticipated the same process that they've used for the payroll, that it would be the self-employment income over that covered period to determine the forgiveness. But again, this is speculation, and we are waiting for more guidance from the SBA or from Congress to get to that particular piece of it.
So
Okay,
Nancy, are you saying that those people should have their tax return done, or just maybe the schedule that would be attached to the loan document?
Yeah, that's a great question. So I have had some clients start to be proactive and reach out to their banks about this on Friday, and the banks have asked for the 2019 tax return. If the 2019 tax return is not prepared yet, and I think that there are going to be a fair amount of them that aren't going to be prepared with this extended due date and, clients still waiting on K-1s possibly, my suggestion would be to provide the Schedule C. For the most part, people should have that information available. If you need to provide an income statement from your accounting records along with the Schedule C, I would have that information available.
Okay, as we're running out of time here, I just want to take a minute to thank Eric, Dan, and Nancy. Our next webinar presented by SVA Financial Group is scheduled for tomorrow, April 8th at 3:00 p.m. and the topic will be maintaining investment strategies during market volatility. We are planning to have another update next Tuesday, but we are waiting to determine the topic. You'll receive an invitation when it's finalized. Based on the number of questions that are still coming into the webinar chat, I know we haven't gotten to everything. We've done our best to cover as much as we can today. I just want to let you know we have set up and created a resource page where the recording of this webinar will be located, as well as additional information and updates on COVID-19. So please bookmark svaaccountants.com/COVID-19 as a resource for you and your business. And before I let you all go, I'd like to remind you that the SVA team is only a phone call or a Zoom meeting away. So if you're a client, please reach out to your SVA professional as questions arise. If you're not currently an SVA client, please contact me, Lee Schwartz, so I can understand how we can help, and I will connect you to the right SVA professional. Thank you again for joining us today, and please stay safe.